So I want to walk back through, perhaps briefly, we'll take as much time as you feel like you need to for us to do this. I want to walk back through our forecasting. And let me change one other thing on my other screen here so I can make sure I'm seeing who I've got. Okay. And we're going to look at explicit and continuation periods again, revenue forecasts, expense forecasts, and we'll look at adjustments. Instead of using Mira Drovana as our example this week, I'm using Farmhill. So you're going to see some different numbers than we saw last week. Hopefully that'll paint this a little bit differently, and I'll even pull up the Farmhill spreadsheets and forecasts for you. And you'll find that Farmhill forecast and spreadsheet, by the way, in my website, richardhaskell.net. It's under Farmhill Simplified, okay, if you're ever wanting to pick it up. Well, first, we got to make sure that we understand each other with respect to explicit and continuation periods. My explicit periods, sometimes referred to as discrete periods, simply start counting time zero from now. So time zero is right now. And time 1, 2, 3, and so on, in this case, are annual periods as they march in front of us. And I am telling you that I'm going to start counting continuation time, or a terminal period, with time 1 coincident with year 4 of my calendar or discrete or explicit time. Well, this would be year 1 in continuation is going to be the first year after my explicit period. So this is a signal to you that my explicit period is a 3-year period. If year 1 is the year after the end of it, and if that's happening in year 4, then year 3 is the end of my explicit. And I can also call the year that's the end of my explicit period, I can call that at year 0. When you saw this for the very first time, as I indicated, it was very counterintuitive and probably confused you mightily. I'm hoping that by now, having seen it in one form or another 4 times, I think maybe 5, that you're starting to get the hang of this discontinuity of time, or this temporal shift, if you will, the way we think of time in these equations. Any question about how I think of this continuation versus explicit periods? Okay. Well, we'll look at an example, part of what we've got going on here. And this example actually kind of shows us a couple of different things. Again, this is the Farmhill case, and I'm showing you the free cash flow model, such that we've got real time 0, which is our base year. And in our base year, if you were to look at that case, which we'll do in just a moment, you'd see that we had a negative cash flow of 0.804. And in the first year of our explicit or our forecasted time period, then we've got a negative still of 3.25. And the next year we improve all the way to a negative 3.5. And I use the term improve facetiously, of course. It went from ugly to bugly, right? But then in year 3 of my continuation, or of my continuous time here, of my discrete time, in year 3, I turn positive. In this case, I have 2 years of an explicit period. Well, how do I know that? I haven't just memorized it, but you can tell that by looking at this, because I'm only counting up years 1 and 2 for the sum of the present value of the discounted cash flows in my explicit period. Okay, let's walk over to the Farmhill case for just a moment. And you'll see here, let me make this a little bit bigger so you can see more. You'll see here that my base year, the year in which I find my financial statement information, 2014, my base year is 2014. And I've got a negative, just as we said, and I'm forecasting another negative. You can see those building right here. And I'm then forecasting a positive to follow. How is it that I go from these negatives that are getting more negative each time to magically going to this positive? What's going on to motivate that? Which might be another way of asking you, why are they negative?
Maybe your growth rate change.
Well, you're exactly right, Solomon. My growth rate change did that. So in this case, we're growing at I think we're telling you 8.6%. I've got this here in my revenue forecast. But then I've got a long run growth of only 3%. So I slow down my growth. Well, what is it about growth that is causing these to be negative? Think about the free cash flow equation. In this case, it's not because we have a negative EBIT, because we don't have a negative EBIT. We have a respectable EBIT. And we're adding depreciation back to it, and that's positive as well. So we got even more positive. But look at what's happening with our fixed assets and net working capital. If you think about the way that this equation is structured, no plat, which is EBIT times 1 minus tax, plus depreciation, minus change in net working capital, minus net capital spending, which is change in fixed assets plus depreciation. Look at what's happening here. We've got a, what, 5.5 million change in net working capital. We've got a 4 million change in fixed assets. Even when we bring depreciation back into that, we're still only barely positive, and we haven't overcome the negative of our massive change in net working capital. So our capital components, which if you'll remember are growing at the same rate as our revenue, our capital components are growing such that they're outpacing our profitability from EBIT and returning to EBIT depreciation and making the tax adjustment. So we're simply growing faster than we can cash flow. That's all a negative free cash flow means when there's a positive EBIT. Now, if EBIT was negative, that's a whole different story, right? That means we have an operating loss, and we need to start digging in and figuring out why that is. We got to correct that problem now. But if you have a positive operating income and a negative free cash flow, that may not be bad. That simply means that the company's opportunities to affect growth are greater than its ability to self-fund that. And it may have to go outside of the company to raise capital. Most of the companies, some of the most dynamic companies out there, from the Ubers to the, for decades, for Google to Tesla, these are companies that are historic with their negative free cash flows because their growth was rampant. I'm not even sure that Google today has a positive free cash flow. I don't know, it might, but its growth is so significant. I don't know that it has a positive free cash flow even today when it is so profitable. Okay, so I need that to make sense to you. Any questions about that?
Yes.
Yes,
What exactly free cash flow represents?
Good question. So I'm going to turn that back to you guys. What does free cash flow represent? Kane, do you have an idea? Anybody can step in here. Emilio? Okay, I see we left our Wheaties.
So free cash flow, which is pretty much anything you can freely use, any cash you can use that's freely available. It's not tied up.
Exactly. So what's freely available to us is our operating income, right? Adjusted for tax and giving us back our depreciation, which was a non-cash deduction to EBIT. So that's cash we have available to us. But then we've made some commitments with cash as well. We committed to these fixed assets as part of our growth. We committed to this change in net working capital as part of our growth. So it's the money we have available from operations, and we're going to subtract from that the money we've committed to other things in the future already. Because that cash that we committed for our future is not free cash flow today. We've already committed it elsewhere.
Yeah, so that my question was that if the company is growing so well, even the net working capital is increasing, which I assume working capital is also something cash or equivalent to cash or something can easily liquidate. So
Yes.
Why the free cash flow is reducing? Like if you see the first two period again, I know the growth rate, but don't you think it should also increase the free cash flow rather than decrease?
No, because in this case, we are making continued significant investments to our company's future through net capital spending. We're buying additional capital assets, right? And then we also have this whole net working capital thing. But let's dig into net working capital for a minute. That's cash plus inventory plus accounts receivable on the current asset side, right? Well, if we're growing as a company, we would hope our cash is growing. We would hope our accounts receivable are growing, but only based upon our sales growth, not because people are paying us on a slower basis. And we would hope that our inventory is growing, although we don't want it to grow greater than our sales are growing. That would mean our inventory is getting bigger and bigger and bigger and disproportionately with our sales. Well, similarly, our accounts payable are going to grow just because we've got more raw materials we're using, more inputs. We're going to pay them, whether it's 30 days, 60 days, 90 days. We're going to pay them out there still. And these things are all keeping pace with each other. But that growth in them in a nominal term, a dollar value term, gets to where it's greater than the growth of our EBIT and our depreciation when adjusted for tax. It just means we're growing faster than we can afford, which, back to thinking about this as investors, that's not a bad story. In fact, that's a saleable story all day long. And we can go out to the market and we can find capital to feed companies that are growing faster than they can afford and being able to sustain the growth on a profitable basis. Because this company is profitable, right? It's got a nice EBITDA. Well, its EBITDA is probably sitting at 11 something, 12 something, almost 13. That's not bad. An EBITDA of 13 against 253 is not a bad margin necessarily. Depends on the industry it's in.
Rick, I'm still a little bit looking for the answer to your question of how it made up $6.5 million in a
Right
year.
here?
Yes, sir.
We slowed down our growth. Excuse me. We slowed down our growth. Our growth went from 8%, 8.6% in all of these years, and we slowed it down to 3%.
Okay. Thank you.
So we didn't have to make that much more of a commitment. In fact, if I want to make this look prettier still, I want to slow down my growth. Well, slowing it down slowed down my growth of EBIT, but it also slowed down the growth of my capital requirements. And now all of a sudden my EBIT, even adjusted for tax, when I add now my depreciation, I've now got a nicely positive story because I'm committing so much less to my capital components as I move into the future. So when you see a negative free cash flow, don't let it bother you unless you can't ever forecast one that's positive. If we had moved this down to 2% or 3% and we still were negative, this company's in trouble. Because if we forecast nothing but negative cash flows, it's going to have a negative value. In which case, Casey's going to have to pay me to buy it from him, which he's not going to want to do, and I'm certainly not going to do. Okay? All right, well, let's keep going. So here, I'm just showing you a structure that you're already familiar with, having done a couple of assignments with this now. And but I want to point out that what we're looking at is the present value of the discounted cash flow, which we're seeing right here. And it's just this summation that's building up here. And I'm looking at a continuing value, which is right here. And I take the present value of that continuing value, which is right here. And the sum of the present value of the discounted cash flow plus the present value of the continuing value is my value. So I want you to think about this structure. This is a discounted cash flow model. And in this case, it's free cash flow, the cash flow we're looking at. But one of the things that these models all have in common is they have a present value of the explicit period's cash flows. And then they have a continuation term that picks up all possible future cash flows into perpetuity. And then they take the present value of that and add that to the other present value, because we can take an apple and we can turn them into an apple. We take an apple and an orange, and I don't know what we've got. It's probably unpalatable and it's certainly unsustainable genetically, right? So all of our valuation models are going to follow that form. As we continue on with our expense forecast, and this is without adjustments, we recognize that we use a series of forecast ratios. And I'll move to the Farm Hill case again, and we'll look at these. So in this case, and it's a simplified case, I've got cost of goods sold as a category that's part of my operating expenses. I've got selling and other administrative expenses as part of my operating expenses, and I have depreciation. So I don't have 5, 6, or 10 categories. I've only got 3. And arguably, I could have only had one. I could have had operating expenses as a category, right? I would still have to keep depreciation as a separate line item because I have to use depreciation as a separable value in my free cash flow equation. So I've got to keep that separated out. So in this case, I looked at my base year, which is 2014. And by the way, this is purposely structured just a tiny bit differently than the Mira Dravana case, where I've put my forecast ratios above rather than below my forecast. And I've only got 2 years of forecast, 3 if you call my continuation year, rather than 5 or 6, okay? So I found my ratio, my forecast ratio here, by taking the base year expense in this category and dividing it by the base year revenue. It gave me a ratio. So I know that my cost of goods sold are going to be 83.33% of my revenues. And I should then be able to use that to forecast my cost of goods sold on into the future. I found that my sales and administrative expenses that year were 11.7% of my revenue, and I should be able to use that relationship. I found the depreciation was 1.53%. I should be able to use that. Notice that I didn't even bother to put here the other values from the financial statements. I don't use them as I am forecasting these other numbers. EBIT, as I forecast it, is simply taking revenue minus those expense categories. No plat is taking my EBIT times 1 minus my tax rate. And then net working capital, I have picked up from the statement. This is what I picked up from the statement. This is what I calculated over a 2-year time frame. And then this was simply no plat divided by invested capital. And invested capital was over from the statement, but I can look and I can see that invested capital can be looked at from a ratio standpoint, or I could have just calculated invested capital by taking net working capital plus fixed assets. It gives me the exact same number. So it doesn't matter which method I use. Well, a couple of things to point out here that I've asked you to not do, and I'm going to implore you not to do them because it'll make your life harder in the future, is even though we might argue that if everything here and here is based on our sales growth, because remember, for our net working capital and fixed assets, we took our revenue growth. So we're growing our capital components the same rate we're growing it, our revenue, so we have constant returns to scale. That's one of the conditions. If I go ahead here, I could argue that my other expenses are also growing at the same rate of sales because they're using that revenue in the denominator. But I've asked you not to do that. I've asked you to go ahead and use the ratios each time. And the reason I want you to use the ratios each time is because when we either relax the constant returns to scale construction, or when we go to add adjustments to them, then it makes it a lot harder to recreate those sheets. The methodology that I'm using here flows over into the methodology for adjustments, and it flows over into methodology for changing returns were we to choose to model changing returns. Okay? Any question as to how I'm going about getting these values? Do I remember correctly that this week's Excel assignment is not using this yet? It's not until next week, or is this week's using this one?
I didn't see an Excel assignment for this week. But
Oh, maybe because I was a nice guy. Let me see.
We did the half, like not everything.
So let me make sure I haven't led you down a garden path of some kind. Stay with me. Yeah, we do. We have an Excel assignment due tonight.
You said we just had to do the top portion
Yeah,
that you're showing us, not the bottom portion of it.
Yeah, we were just doing the half, not the bottom.
the upper portion.
Yeah, just
Yeah.
the forecasting we're doing.
Oh,
Great, it's right here.
Yeah.
I did both.
Okay, well, and that's good because frankly, doing the second part is a walk in the park. Okay, but yeah, so you should be able to do this, and I'll give you through this coming week to finish the whole thing before you submit. So you're fine. But so you should have begun this unless you're unless you just really like putting things off to the last minute, which frankly, based on the number of calls I usually get on Sundays, I know that you put things off to the last minute sometimes. I also know you guys have all kinds of other stuff going on and you're juggling all your schedule issues. But yeah, so what we've just discussed is exactly what's at play right here. So now let's go in and talk about adjustments a little bit. Well, actually, before adjustments, let's talk about these other scale assumption ratios. You'll remember I told you we're going to use a constant invested capital revenue ratio. And if we do that, we can then use that ratio to help us find the next invested capital. And I'll show you on the spreadsheet in just a moment how that works. We're doing the same thing with a debt ratio. So let's go back and look at this. Again, using Farm Hill. See here, I've set this up so I've got a constant revenue to invested capital ratio. And I don't care if you use revenue to invested capital or invested capital to revenue. It's a constant ratio that you can then use to help you forecast something. So if I'm wanting to forecast my invested capital, rather than do it by adding net working capital and fixed assets, if I've got a constant relationship here with revenue, I should be able to use that relationship. And I should be able to forecast my invested capital. In this case, if I've got a revenue to invested capital ratio and I'm trying to forecast invested capital, I should be able to say that whatever my revenue is divided by that ratio should equal invested capital. I'm just playing a little bit of algebra here using a constant ratio. And I can do it for that year and that year and that year. It's the same relationship, but it's a constant returns relationship. Let me go ahead and come over here real quickly and show you how I could have done the exact same thing had it been an invested capital to revenue ratio. I just want to make sure that you're not confused with that. So I can take an invested capital for my base year, divide it by the revenue for my base year, and it gives me this 0.433 number, not the 0.230, because I'm inverting the equation, okay? And if I want to use that relationship to forecast my invested capital, so I'm going to do another invested capital column here, I can just go ahead and say that ratio times this revenue would give me invested capital. And notice it gave me 119.29, which is exactly what it's given me over here. So whether you invert the equation or not, it doesn't make any difference that you have invested capital and revenue in the equation, regardless of their order, and it creates a ratio, and then you algebraically use that ratio as a forecasting function. They'll get your job done. And by the way, I can even look at it yet differently here as well. Another column for invested capital, which is going to simply equal my net working capital plus my fixed assets. And it gives me the exact same number because they're both credible methodologies in a constant returns world. Well, I've done that, and I've been able to forecast my invested capital. I could have done it a couple of different ways. I've also given myself a assumed debt to invested capital ratio. Why do I give myself this ratio when interest expense is not part of free cash flow? Why did I bother forecasting debt? You remember free cash flow has got nothing to do with interest expense, right? Well, I've done that because maybe there's more I'd like to do with this at some point. Maybe I want to think about net income. Maybe I want to think about this APV model over here and a tax shield. And you're going to find as we go through our discussion tonight, the tax shield's a function of our interest expense. And unless I know my debt burden, I don't know what my interest expense is. So for this particular model form, as you'll see before the end of the evening, we do need to know interest, which means we need to know debt. And the only way for us to know debt is to make an assumption as to our ratios for debt. And in this case, in constant returns, we have found that those companies that are subject to constant returns or that have found themselves in a constant returns regime have a very consistent relationship between invested capital and their debt level. They tend to create an appetite for debt, for the risk that comes with debt, and companies tend to stay within that range. They tend not to venture out of it much at all. Okay, so for this part of what we're looking at, any questions? Okay, let's go into our adjustments now. Well, how am I going to go about using my adjustments? I've said here that I've got a revenue forecast of 8.6, and then I've got some best owner premium. I don't know what that means, by the way. Maybe one of you can tell me, of another 2%. How am I going to use that here?
You're going to add it to your total of 8.6%.
That's exactly right, okay? I'm going to take my revenue from the prior period, this 253.64. I'm going to multiply it by 1 plus my forecast for growth plus that additional adjustment or premium. And that gives me my revenue for the next year. Now, I've done something else here. It's important for you guys to know. I got some footnotes down here that you want to pay attention to. And I've referenced my footnotes right there in 1 and 2, okay? And in this case, if you read through this, I'm telling you that I don't think that my adjustment to revenue, my best owner premium, is persistent. That I think after the first year, half will go away, and after the next year, another half will go away. So see how I've modeled that. In the first year, I use the whole thing, right? I take the 8.6% and I add all 2% to it. And the next year, I only took half of it. I took the 8.6% and then I only took half of this 2% adjustment. And the next year, well, in this case, I didn't take it at all. So pay attention when you're replicating this in the Excel assignment. And the Excel assignment is for more years than this, of course, and it's for a different company. But I think, if I remember correctly, I might have this persistency issue built into that as well. In fact, let's look at that real quick. I think you're doing Mirror Dravana. I want to make sure. No, in this case, I didn't model a persistency issue. You don't have to worry about it. But you may choose to, because think about it, not all revenue enhancements, not all revenue premiums are persistent. Maybe once we've sold more into a particular marketplace, we get the benefit over time from that, but then it slows down or it stops because we've already penetrated that market as much as we're going to, and for our adjustment. But now we can look at this and say, okay, we believe for some reason we've got an adjustment of 3% in our cost of goods sold, another adjustment of another 3% in our sales and administrative expenses. Well, what does that mean? That means that we believe we're going to be able to save an additional 3% off of our COGS, an additional 3% off our sales and administration costs. And we believe that for whatever reason. Maybe Casey's bought the company and he's a better owner of the company than I am, and he's able to negotiate better contracts. Or Nate has come to our company as the new CEO, and when he came, he brought some great vendor relationships with him. And we can just negotiate better prices. Or maybe it's been a while since we went and negotiated prices with our suppliers, and we realized we're paying too much, and we're going to go and beat them up for discounts. And they're going to only give us the discounts they can afford to give us. They're not going to let us discount them into oblivion, or at least hopefully they won't. And hopefully you'll never ask for a company to do that. If you do, then you have a short-term relationship, and you're not going to be able to rely on that business partner because they're going to go out of business, okay? So look at how we've applied these. Remember I showed you 2 methods last week. I'll go back to my forecasts here. I showed you 2 methods that yielded 2 different values, either taking the operating expense ratio, so the forecast ratio times the revenue, identifying that as a value, and then multiplying it by 1 minus the adjustment, which is the correct way to do it. Or if you're not thinking about this well, you might take the forecast ratio plus the adjustment and then multiplying that by the revenue. But when we do it, it gives us 2 different values, 630.5 when done it properly, or 680 when doing it improperly. Well, here, if I do it improperly, I'm overstating my expense, so I'm understating my EBIT, my operating income, and I'm going to understate my company's value. Well, I don't want to do that. That's not going to get me a bonus. It's not going to get me any place in the corporate offices or buy me any truck with my stakeholders. So you've got to do it the right way. And there's the correct way that I've given you in the slides, and there's the incorrect way. And so let's look at how using the correct way plays out. So I've gone ahead, just as I've told you, I've taken my revenue for the year or for the period. I've multiplied it by my ratio. And then I multiply that number by 1 minus my adjustment, which means our adjustment is an adjustment on the actual forecasted expense. It's not an adjustment proportionately across the entire revenue structure. I find first the forecasted expense without the adjustment, and then I apply the adjustment to it. So I didn't say we were going to have a reduction in cost of 3% of our revenue amount. So we're going to have a reduction in cost of 3%, what that cost was. So we've got a methodology, we've got to methodologically keep it consistent and accurate. Any question about how I've done that?
Can I just ask you to, I maybe have a question on the revenue.
Okay.
Sorry. I can't see the discounts, or I'm sorry, the adjustment percentages at the top. You asked King about it, and that. Yeah. Wasn't there another one? And then my other question is.
In these?
Yes, sir. So I'm trying to understand if it's yielding an 8.6% and the market leader premium is already built in. Why do we do
Let's
this?
walk through this for a minute then, okay? So we're saying in this case, we believe that the market in which this firm sells its products and services should see a 6% increase just because of market activity. Here we're selling shoes, and the shoe market is increasing at 6% a year for whatever reason. We've observed that. We've got economics reports, etc. And our shoes tend to be a better shoe. They're a more quality shoe. And as a more quality shoe, we get a bigger bump in our revenues because people like to buy quality more than they like to buy junk, let's say. And then not only are they a better quality shoe, and are we able to get the market averages in our increase, we're a better run company as well. We got a better marketing program. Heck, I've got Nate McDowell here that is the marketing VP. He consistently delivers more to us than anybody else in the industry. Well, that might be our market leader premium. So I'm just giving you a couple of categories of hypothetical sources of revenue. But now, when I apply this adjustment, we're thinking about this adjustment because something else is coming along. And in this case, we're saying it's a best owner. So Casey's come along and bought this company. And the company already has all these things because Nate works for it. It's in the same industry. We still are the best quality in the industry. So we get that 8.6, but for whatever reason, maybe Casey's introducing us to a marketplace in another country we couldn't take ourselves to. Maybe he's introducing us to a market of customers that are his customers on some other products, and they're likely to buy these products from us as well as his products, and that's giving us an overall bump in sales. We call that a best owner premium.
Okay. Sorry, guys. What I did is I thought it was market leader premium repeating itself versus best owner premium. I'm sorry.
Yeah, that's okay. That's okay. I'm glad to have the questions. Just how we all learn. Okay. Well, I apply this adjustment. I apply another one here. And that's going to give me a reduction. It's going to change my EBIT. But why didn't I apply an adjustment of some kind in depreciation? Why am I just going to take depreciation at its original ratio? I don't really care which of you answers the question. I just want somebody to do it.
Because we're told to by
No,
regulations and guidelines.
It's a function of revenue.
Well,
right?
and actually, depreciation is a function of two things. It's not really a function of revenue. It's a function of our fixed assets that we're depreciating, right? And in this case, our fixed assets were a function of revenue because of constant returns to scale. There's a function of our fixed assets, and it's a function of some regulatory guidelines that tell us what we can depreciate and what we can't. We can't manage it. It is what it is. Oh, we might choose to lease assets instead of buy them, in which case we don't get to depreciate something we leased. We can only depreciate something we own. But that's a different methodology altogether. So we don't have any real control over that. So I'm not going to forecast an adjustment with it. Now you might, in another scenario, say, well, wait a minute. Maybe I do have some latitude there, whether it's through leasing or whether it's through the kind of asset I buy for a particular purpose versus another one. And maybe you would find a method there that would cause you to impose an adjustment here. But by and large, I don't think that's that's very adjustable as a category. Well, I've gone ahead then, I forecast the rest of this out just exactly what we did in the other one. Notice here that we come up with some pretty interesting changes in value. Like I'm going to come back to our our PowerPoints for a moment. Here you see the exact same numbers that we were just looking at. But now look at what happens to our value change. So here we've got, without the adjustments, we had a value on the exact same cash flows. Our free cash flow here is exactly what it was. We've got a value of 102.25. But we apply those adjustments. And remember, those adjustments were trivial adjustments. Those adjustments were 3% savings in a couple of categories, 2% increase in revenue. I mean, come on, you guys, how hard is it to get a 2% bump in revenue if you put the considerable mind of Nate McDowell and his marketing geniuses to it? They're going to come up with it, right? Well, when we did that, it gave us meaningfully improved cash flows. In fact, we went from these negative cash flows to nicely positive ones. And we went from a value of 102.25 to 357.5 by just a couple of little 2 and 3% adjustments. So even though we can trivialize the effort that we think it might take to get those adjustments, this is not a trivial change in value. This is a monumental. This is a 2.5 times, 3.5 times change in value by having some 2 and 3% adjustments. That's huge. I want to look at one other thing here. And we kind of touched on this briefly last week. So now let's go ahead and think about it a little bit more robustly. So we've applied these premiums over here in the with adjustments category to get us some pretty impressive values, right? Went from 102 in value to 357. That's hotter than a pistol. We didn't change the discount rate. We just changed a little bit of our selling. We changed a little bit of our expensing. We got some improvements in the operation in that respect, and it dramatically changed the value of the company. So here we are. Scott, I'll have you come off mute for a minute. And you know, as an investor, that if this company is going to be purchased, they absolutely will not take anything less than 102, right?
That is correct.
Because that is their estimation of their value using their cash flows, their relationships, their discount rate. In fact, are they likely to let themselves be bought for 102.25?
Without adjustments, yeah, they probably are.
And I'm going to argue that they probably aren't, even without adjustments. And here's how. So let's assume I got a dozen or so of you that are on the call with us at the moment. And Heather, I go ahead and buy some of your stock. And I buy it at the market value, right? Because if I'm just buying some of your stock, you sell it to me at market. Right?
Yeah.
Yeah. And then Jason, I want to buy some of yours as well. And you're probably also going to sell it to me at market. Unless you know I'm trying to buy everybody's stock. By the time I go to try to buy Nate's stock, we see that the volume of purchases in this market have increased beyond what they normally are. I'm taking shareholders out. Are you going to be satisfied with what they paid, knowing that I'm a buyer and I keep buying? And so supply is not increasing, but demand is increased for this good, which is the share of common stock? Or are you going to make me pay up for it? I think Nate might have fallen asleep. Casey, help him out.
You're going to increase your price.
I'm going to increase my price.
I'm not going to give it away easily when I know you
No,
want
of
it.
course not. And Solomon sees this gravy train coming. And Solomon, you're going to want a bigger price than Casey. And then Kang's going to want a bigger price still. And then finally, we're getting all the way down to Ian. Ian is the last shareholder for whose stock we haven't purchased yet. Ian, you can come off of mute if you hear us. Are you going to be satisfied with getting what everybody else got? Or if you're the last holdout, are you going to rob me blind?
I think I'm going to rob you blind there because it's going to be at a premium.
Because you and I are proud capitalist pigs, right?
Yep.
Absolutely. So I don't think I can realistically get it for 102. However, I know that I've got these adjustments. I'm going to do some things with this company that its current ownership's not doing. Those adjustments are going to let me pay based upon the discount rate that the company's using all the way up to 357. Well, I'm also not going to do that. But not only because 357 is a big move, it's because there's no way I could even consider affording to pay 357. Look at this for a minute. These are constructed using the company's cost of capital, right? The company's WACC. If I come in and buy this and make these adjustments, I'm investing something more than simply my capital. And if I invest something more than my capital, I should be able to expect a return greater than my cost of capital, right? If I invest relationships, I invest innovation, if I invest vendor contracts, all these other things, if I expose you to new market that you couldn't have had on your own, then it increases the value, but I expect a higher return, in which case, if I'm going to expect a higher return, I'm going to impose a higher discount rate. So let me come back here. I'll come to our adjustments. Here you can see, well, let's see. I got to put these 3% back in place, these 2s and 3s. And I'm going to come to the company. Remember, I had the company's WACC here at 5.52. So if I put that in here, 0.0552, it's where I get my 350 something number, right? But in this case, if I'm going to invest something more than simply my capital, I'm going to invest my relationships, my managerial prowess, all this other stuff. I want a bigger return. Let's say I want almost double that. I want a 10% discount rate. So that, even with the adjustments, that's going to water this down to about 128.5 because I changed the discount rate. So now let me put all three of these values on the same slide for you. We can talk about them. Here I have in these first two, I'm using the free cash flow model. I'm using the company's WACC without adjustments and with adjustments. But here, I'm using my required return of 10% because I'm investing something more than simply my capital. And even with the adjustments, I'm now only at 128.5. So in this case, I know I can't buy it for 102.25 because you people won't sell it to me for 102.25. Somebody, at least Ian, is going to be a holdout that's going to make me pay up. But I think you're all going to make me pay up because you're not stupid. You realize what's going on. Even Heather's going to say, wait a minute, I'm not going to sell it to him at market. He wants to buy the whole thing. We expect a premium. And we know he's going to do something more with it, but we know he's going to expect a higher return. So this spread between this 102.25 and this 128.5 is what I could still afford to pay for this and receive my 10% return. This is the method underlying why companies that are acquired in the open market, their common stock goes at a premium above the market price. This is what belies that. Does this make sense?
Mm-hmm.
Do you have a name that you give to that difference between the 102,000 in this case and 128,000? Does that have a name?
You know, that's a good question, Casey. It's possible that it does, but I don't know what it is. To be honest with you, I sometimes think of it as the difference between bid and ask. I don't know that that's universally accurate, but I kind of think of it that way sometimes.
It's a helpful concept if you consider that the company, you're buying one stock of the whole company rather than, just a few.
Yeah, exactly. So think about that. That's interesting to know. You'll look back at this video, and obviously, we'll probably play with this at least one other time before we are done with the 7 weeks together. So any questions here before I move on at all?